My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and put these days into perspective. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We're entering the high peaks region of the stock market. Yes, this is the place where we spot peaks everywhere. Last week, a regional Fed president seemed heedless of any data, talking about raising rates in a recession. In light of new data, that could be peak hawkishness. Today, we got a number showing that job openings fell 10%. Could that be peak employment? If that's the case, we might also be looking at peak treasury yields. And that's how we could have a second day of explosive gains in a row. Yes, Dow surging 825.43 points, S&P soaring 3.06%, and the Nasdaq plummeting 3.34%. Now, coming this week, the market had gotten as oversold as it was when the pandemic started. As oversold as we were when Fed Chief Jay Powell ill-advisedly talked about lockstep rate hikes in late 2018. Could it be peak oversold? Meanwhile, we've seen the dollar drop 4% in just a few days. An extraordinary move. Peak greenback. We have the possibility of Elon Musk paying full price for Twitter, $54.20 per share. No question. Let's call it peak enthusiasm, to put it kindly, for a brand which is worth way less. Now, that is indeed a range of great peaks. I don't know, rivaling the Himalayas, or how about the Adirondacks, along with one that should be irrelevant, which is that Twitter peak, although it played a role in today's enthusiastically bullish session. So what does the navigation of this high peak region tell us about the stock market and your portfolio? First, let's just say that things are very much in flux by the day, because each day gives us a new piece of data that impacts the markets, most particularly the all-important two-year Treasury. I want you to consider the two-year as a kind of a thermometer, all right? When a piece of data comes in hot, the thermometer shows that the market's sick and needs medicine. The medicine means, yes, rate hikes, like your neck. Coming this week, I'd say the thermometer was at 103 degrees, meaning we've got a serious fever, but it's not life-threatening. We're very much in need of the Fed's rate hike medicine. We just don't know the dosage. And this is really important. I hear a lot of people say, well, look, they're doing rate hikes. That's ridiculous. No, it's the size of the rate hikes that matter, not the rate hikes. We need to know the dosage. I mean, who knows? Unfortunately, this medicine, it reminds me of chemotherapy. Rate hikes will kill the disease, inflation, but also do serious harm to the patient. And that harm is recession. You know I try to use these metaphors whenever I can, analogs. Get you to understand this stuff because it's complicated. For instance, yesterday we got a purchasing managers index number for manufacturing. It was weaker. It sent the thermometer lower. Let's say 102, okay? And it weakened the case of the Fed's most hawkish members who want to administer chemo no matter what. And you know what that would do ultimately to the patient? Today, we got another weaker number, the job opening number, which showed a 10% decline in August. That's the biggest drop in nearly 2.5 years. That's another piece of data that sent the temperature lower. You get two pieces of cooler data, and it makes you wonder if maybe Loretta Mester, that's the Fed's most aggressive hawk urging maximum chemo, might have less influence. Maybe even her hawkishness has peaked. Maybe Treasury yields have peaked, too. The two-year looked like it was about to gallop to 5% last week, a crazy high number. Now it's back down to just above 4, and it might be even headed down to what we call a 3 handle. Now, a lot of this temperature taking is counterintuitive, right? I mean, how can weaker manufacturing be good for the economy? Of course it's not good. But it's a positive development because the alternative is runaway inflation.
The House of Pain.
If we get strong data, it means the Fed will have to bring even more pain and engineer an even harsh recession. Yes, that's what's at stake. Same goes for these job openings numbers that we talked about today. Nobody likes to see the number of job openings go down, especially if you're looking for work. But if you're looking for a cooler economy, which we are, then the number was a godsend. The Fed's #1 priority is bringing down wage inflation, and they're finally making progress, meaning the rate hikes might not need to be as aggressive going forward.
House of pleasure.
So what does the dollar have to do with it? The dollar's gotten insanely strong. The higher it goes, the worse it is for our companies that do business overseas. If you sell goods in a foreign currency, a strong dollar means your foreign sales translate into fewer greenbacks. Plus, a strong dollar makes our exporters our exports are just less competitive against each other. Well, let me give you an example. In short, the decline's fabulous news, say, for Caterpillar. There's a stock that's been soaring because a weaker currency makes it easier for them to fend off Komatsu and Kubota. You ever see those big earth movers on the side of the road? When you see Kubota, well, that means it's not going to Cat. They're big competitors. Maybe a weakening dollar can help offset the domestic weakness, softening the blow of a potential recession and bolstering the earnings of our exporters, especially the tech companies, which have been completely slaughtered by an unfavorable exchange rate. Hence why tech roared today. If the Fed can navigate the high peaks region, there's no reason to think we need to go into recession, even as you hear it endlessly on air. It's not bipolar. Now, I am definitely not against rate hikes, but they come in different sizes. 25 basis points, 50 basis points, 75 basis points. We've now had 3 of those 75 basis point hikes in a row, and I think we could use some smaller ones going forward, maybe 25 basis points even. Given the cooler data we've been seeing, the Fed doesn't have to kill the patient to save it from inflation. Even a 50 basis point hike might be a decent dose, with another final 50 basis point, if necessary, down the road, when we can adjust to it. However, the hawks want to keep prescribing the same high dosage without checking to see how the patient's doing. And to me, that seems downright reckless. You know what I favor? Prudence. Again, the situation's fluid. We take the economy's temperature every day, including a big reading this Friday with that non-farm payrolls report. We might wonder once again whether if we're seeing peak hawkishness from the Fed all over again. But you know what we won't question? How about peak foolishness in the form of the $54.20 per share that Elon Musk has agreed to pay for Twitter, a price arrived at in a fit of pique that no court in Delaware, where Twitter's incorporated, would overturn. Of course, Musk paying too much versus what the stock would be worth if he weren't involved, but nobody forced him to make a bid. He just got real unlucky with the timing. Frankly, I'm glad that Musk threw in the towel and agreed to pay up, recognized that the Delaware Chancery Court was going to enforce the terms of the deal anyway, so wasted time to fight it. But I recognize, how about this? I actually don't fear Elon Musk. I'm gonna call it peak foolishness because I know when I see it. And so does Elon. And that's why he was so eager to get out of it. Twitter's 22% run today in response confirms that the market may have gotten to peak oversold last week. It's not that Musk's an idiot for overpaying. It's that the market got excessively negative. The S&P short-term oscillator I use to measure oversold conditions hit -10 coming into this week, a reading that's almost always preceded a snapback rally. Twitter at 54.20, way too high. But the action in the social media space makes me think that, well, it'd be at 20 with Musk's takeover, and that seems stupidly low in retrospect. $20 is probably where it would be without him. Can you imagine? Of course, the idea that we need to take the temperature of this market every day seems stupid. But can I just ask you ever been in a hospital? When you're sick, they hook up a monitor. In comparison, daily reading's pretty benign. Here's the bottom line. Now that we're finally seeing signs of a slowdown in most of the important parts of the economy, this rampant inflation may not be as malignant as the hawks seem to believe. And that means the Fed might ratchet down the next dose of chemo. Hence today's tremendous run. Well, maybe with staying power, at least until the next reading of the 2-year Treasury thermometer. Let's go to Kevin in North Carolina. Kevin.
Hey, Jim. Long time, first time club member here. Calling about
thank you for being in the club. Thank you. We're working as hard as we can for you. What's up?
Yeah, I'm calling about an old favorite of yours, Shopify. I've made a bunch of money in the stock over the years, but I'm down big in my current position, even after today's bounce. Should I hold, buy more, or sell and put that money to work in other club names?
Well, you know, I turn negative on Shopify because I'm not recommending the stock of any company that is losing money. Not one. Not one. So in that sense, Shopify probably goes up maybe again tomorrow. We got a nice gain today, 10%. I do need you to take evasive action. We're not recommending stocks of companies that lose money. John in Florida. John.
How you doing today?
John, good day. How about you?
Marvelous. So I'm thinking the market should be showing some more RESPECT for our friends in Motown, specifically Ford. 197% sales increase in the same period EV sales reported earlier. They have a market cap of only 1/3 of the total revenue of the company. PE of barely over 4.
Well, John, but I can run for a second. I apologize. But the problem is they have not been able to get the parts they need to be able to deliver the cars that we all want, including the Bronco, the Mach-E, whatever, the 150. Until they get all the parts they need, then they're not going to be able to do the numbers that we want. Now that we're finally seeing signs of a slowdown in most important parts of the economy, maybe we are seeing peak hawkishness. Hence today's tremendous run. All Mad tonight. Suntory, the company behind Jim Beam and Maker's Mark, has a new focus on premiumization. I'm taking a close look at the spirits business to see how the company's doing with the top brass. Then, we're on day 2 of this rally, but does it have staying power? How about we go off the charts to find out? And Biohaven is now a part of Pfizer after a multi-billion-dollar acquisition. So what's next for the company behind one of the most successful migraine drugs in history? I'm discussing the future with Biohaven CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.